subject matter in question. So electric, R&D. I think our next one's on plastic packaging tax. So if anybody's got any suggestions for a good intro song for plastic packaging, feel free to bob them in the chat box. I'll just give it a couple more seconds for people to come in and we'll get started. Okay, well, that's 9:30, so we'll get started. Thank you very much for coming along today, guys. We're doing a webinar today on R&D tax credits. A few general bits to go through before we start. Oh, sorry, we nearly had the song on again. It's going to be presented today by myself, Ryan, and my colleague Ben Aris, who's one of our tax consultants with PD Tax, and my colleague Laura, who's another one of our tax consultants. It's also on the call in case we do anything silly on Zoom. Just have to make sure we don't make any major mistakes. And also she'll be asking some questions. A little bit of general background on our firm. Our vision is that we want to enrich people's lives by making tax simple, and our mission is detailed there as well. I won't read it out. What we aim to do really is to help businesses and individuals to save tax, but really what we do is we help them to achieve their objectives tax effectively, because taxes can be a bit of a maze at times, so making sure you're doing things right is quite important, and that's what we try and help people to do. What we do in practical terms is we provide tax advice. We don't provide any form of accountancy services, we just provide tax advice. That comes under a lot of forms. We do provide a tax director service for accountancy firms, so we can operate as a cost-effective in-house tax team for an accountancy firm if on certain areas of tax that they might need help with. We provide tax returns, company tax returns, personal tax returns. We also do share valuations, and we assist with tax investigations and voluntary disclosures. And we also do R&D tax credits. It's just a few of the things that we help our clients with. A little general housekeeping before we begin. The webinar will finish at around 10 AM, well, actually 10 AM sharp, let's say. Your microphones will be disabled all the way through, but if you do have any questions, please do bob them into the Q&A box. If we have a few minutes at the end, Laura will ask us those questions. If we don't get a chance to answer your question, we will get in touch with you after the session for a follow-up discussion. But after the 10 AM session, we do have a little breakout session at the end where your mics will be enabled, and if you want to stick around and ask any questions to me and Ben, you can do so. If you need to get off at 10 o'clock sharp, that's fine as well. And just a disclaimer there, this presentation is just for general information purposes, so if you do have any technical situations that require tax expertise, we would recommend speaking to some competent professionals before taking any action. So I'll hand you over now to my colleague Ben, who's going to take you through what R&D is and the types of expenditure that should qualify for R&D tax relief. You go, Ben.
All right. Thanks, Ryan. So yeah, good morning, everyone. So what are R&D allowances? Well, they're a tax relief for companies that can assist in reducing a company's corporation tax bill, or potentially surrender part of the trading loss for a tax refund. And essentially, the government provides an incentive for companies to invest in innovation. Now, as we're going to discuss shortly as well, the R&D project takes place where the specific project seeks to achieve an advancement in science or technology. And relevant R&D expenditure for a company means when it relates to a trade carried on by that company, or which is tended by that a trade deriving from that R&D will be carried on by that company. Next slide. I think we're just having a few technical issues. There we go. Excellent. So as stated previously, R&D takes place where the project seeks an advance in science or technology. Now, this advancement means an advance in overall knowledge or capability in the field of science and technology. And HMRC confirmed in a manual that the advancement is in the whole field and not just the company's own state of knowledge or capability alone. This advance can either be tangible, so you might have an improved product, or an improvement to the process which generates less waste, or you could have an intangible advancement, which is new knowledge or cost improvements. Now, it's not necessary that the advance needs to actually take place. R&D will still take place where the advance is not achieved and not fully realised, but there does need to be some sort of attempt made in the R&D activity. Now, the activities that qualify, they need to qualify under the relevant accounting principles and under the relevant government guidelines. So dealing with the accounting sort of guidelines, first of all, it will depend on how you prepare your accounts. So you might prepare them under FRS 102, FRS 105, or IFRS. Now, the definition on the slides here can be found for FRS 102. And we don't have time to go through all the potential qualifying activities for FRS 102. But I have made reference there on the slides if you want to go away and look at them at another time. But they can include activities aimed at obtaining new knowledge, the search for evaluation, final selection of applications of research findings or other knowledge, and the design, construction, and testing of pre-production or pre-use prototypes and models. Now, once you've met the first definition, then you then need to meet the definition of the Department for Business Innovation Skills Guidelines. And these guidelines state that activities that qualify for R&D, if they directly contribute to the advancement through the resolution of scientific or technological uncertainty. And this means where knowledge of whether something is feasible and is not readily available and cannot be easily produced by a competent professional. Now, examples of activities that which do directly contribute and don't are referenced on the slide there, the paragraphs. And I've briefly mentioned a few below there that don't qualify, such as administrative and support services, there's like cleaning and security, or commercial and financial steps necessary for innovation and the development and marketing of the product or service. Or as well, not included on the slide, but work to develop non-scientific or non-technological aspects of new or improved processes, products, or services. Now, great, you've sorted out that you've got a qualifying activity. What's the next step? Well, you need to decide whether or not you have to qualify an R&D expenditure. An expenditure needs to be attributable to the R&D activity and undertaken by the company or on its behalf, subject to certain subcontracting rules. And the certain costs that must be incurred are referenced there on the slide in the specific subsection there as well. And they include staffing costs, software or consumable items, relevant payments to the subject of clinical trials, subcontracted R&D costs, or externally provided workers. It was announced on the first, well, it was announced in the recent budget on the 1st of April 23, expenditure on data, cloud computing, and pure mathematics will be included as qualifying expenditure. So you probably want to keep an eye on that on the next Finance Act to see if that comes through to fruition. Just another couple of points. For a company to claim R&D tax relief, there must be a going concern. So companies that are in liquidation or administration will not be able to claim R&D tax relief. The expenditure must also be incurred must not be incurred in the carrying out activities contracted out to the company, and it must also not be subsidised as well. The expenditure must be revenue in nature, not capital in nature as well. If it is capital, other reliefs may be available, such as capital allowances and first year allowances, but probably seek tax advice on this point just to make sure that the position is clear. Now, we don't have time to go through all of the qualifying activities all the qualifying expenditures, but I will mention a couple. And first of all, you've got staffing costs. Now, I've listed a couple on there which will be qualifying staffing costs. So you have earnings of the directors and employees paid because of their employment, with the exception of benefit in kind. You don't include the benefit in kinds. You've got your secondary class 1 national insurance contributions paid by the company. And you've also pension contributions when they are paid for the benefit of the employees. Now, these staff costs attributable to the project must relate to the staff that are directly and actively involved in the R&D project, the activities. So if some staff are providing mere support services such as secretarial administrative support, you need to exclude them. But if these staff are directly and actively involved in qualifying indirect activities part of the project, then they may be actually able to qualify for R&D still. And then the next one we're going to talk about today is software, consumable, or transformable items. So these will qualify if they're directly employed into the relevant R&D activity. Now, let's start off with software. So software employed in the provision of support services, such as admin, is not directly employed in the relevant R&D, so it doesn't qualify. Let's say that you have software that's used by human resources for routine work relating to those R&D staff, then that will qualify. Then you got qualified, and then you got consumable items. They will include water, fuel, and power. And in addition to this, there will need to be apportionment if these consumable items are only partly used for R&D activities. So you may, it will depend on the circumstances, but you may have to decide on floor area. That might come into factor. Now, HMRC's guidance is that consumable items are items which are used by R&D and no longer used in their original form, because they're either finished up or they have been transformed. Now, the tax relief available will depend on whether the company is considered an SME or a large company. And Ryan's going to talk you through soon the differences between these. But a large company is one which is not an SME, and that's with the legislative reference there. Now, the term SME is an SME under the Commission Recommendation number 2003-361, and this is given effect by the Corporation Tax Act 2009. Now, generally being considered an SME is more favourable for R&D purposes. And to be considered an SME, put the conditions there on the slide. The staff head count must be less than 500, and either the annual turnover must not exceed 100 million euros, or the annual balance sheet must not exceed 86 million euros. Where the company has linked or partner enterprises, they also need to be taken into account when you're considering these conditions here. And a linked enterprise is where one enterprise is able to exercise control over the other company. And this could be, for example, where the company has 50% voting rights in the other company. So you might be looking at some sort of parent company situation here. Now, a partner enterprise is different because they're not a linked enterprise, but they are where one, either on its own or jointly with another linked enterprise, they hold 25% or more of the capital or voting rights in the other. And there's certain relaxation rules, such as for universities, but I won't go into discussion on today. And finally, there are some circumstances where someone goes from an SME to a large under definition or vice versa. There are transitional rules that apply to this. So give me a call afterwards if you want to have a chat regarding these. And we can have a chat about it. But apart from that, that's all I've got covered today. I think Ryan's going to graciously take you through to the poll.
Brilliant. Thank you for that, Ben. Yeah, we're just going to split up the webinar today with a little poll, and the poll is on your screen now. What industries do you think are most likely to engage in research and development? The responses are manufacturing, IT, technology and communications, construction, agriculture, retail, or scientific research. So I'll launch the poll now, and you can all have 30 seconds to submit your responses. I haven't had any responses yet. If you want to, Bob, it should be on the screen now.
I mean, Ryan, we've had a few clients, haven't we, that about manufacturing. We've had a few manufacturing.
Yeah. I'll stop sharing that now. We didn't get any responses there, unfortunately. But I would say that really, people might be inclined to think that things like IT and technology, scientific research, and more common areas, you really can find research and development in all areas and industries. It really depends on the nature of the activity that you're undertaking and what the activity is trying to achieve.
Oh, right. I think it wasn't letting them select an answer for some reason.
Oh, really? Is that what it was? Yeah. I'm sorry. Yeah, I'm very sorry. Let me try that.
Martin's just popped up with a message. Thank you, Martin.
Sorry about that, guys. You can't have a good webinar without one or two technical difficulties.
Absolutely.
So yeah, I'm just going to lead on from where Ben introduced there about large and small and medium-sized enterprises. it's important to understand whether you're large or whether you're a small medium-sized enterprise, because it changes the way that you claim R&D tax credits. And really, as Ben pointed out, the SME scheme is a lot more favourable. Now, the SME scheme and SME companies are probably the ones that we're most likely to deal with. But you may come across situations where you have a client that is an SME that gets bought out by a larger corporation, or vice versa, where an SME scheme leaves a larger group, where an SME leaves a larger group and would subsequently have been under the RDEC scheme. But in an ideal world, we want to try and get the SME tax credit where we can. And the reason for that is that and this is to understand how the relief actually works. Ben's been through it. You've got qualifying activity, you have incurred qualifying expenditure. So how does what benefit is there to the company? And the way that it works is that, ordinarily a trading company would be able to deduct 100% of its relevant expenditure against its trade, things like its staff costs, its property costs, etc. And what the difference between the two would be subject to corporation tax at 19%. If you have a qualifying R&D activity and qualifying R&D expenditure, that expenditure can get 230% relief. So that's an additional 130% tax relief that can be set against the profits. So what it ends up doing is increasing the costs and reducing the amount of profits that are subject to corporation tax. And in effect, the relief works by having 130% of the costs times by 19%, and that is the benefit to the company. Now, I've noted there that potentially that might increase going forward, because the government has announced that for companies with profits over 250,000, they will be subject to corporation tax at rates of 25%. So going forward, the relief might be even better. It would be 25% of 130% of your qualifying expenditure. Now, where you have a company that's potentially already making a loss, or as a result of the enhanced expenditure, it puts the company into a loss-making position, there is an additional tax credit that we can look at. And instead of claiming the loss, what the company can do is surrender that loss for a repayable tax credit. It's slightly less. The percentage rate is less, it's 14.5% rather than 19%, but what it is a cash injection into the company. It's a repayment from the government for that qualifying expenditure, so it can be quite beneficial. The flip side is the RDEC scheme. If you find yourself, or if your company is a large company or is part of a group that, as a result of the group structure, is deemed a large company as a whole for R&D, then it can still claim research and development tax relief, but it would claim R&D relief under the RDEC scheme. Now, officially the rate is 13%, but the calculation method, which I won't go through in this webinar, is a little bit different, and actually the credit also forms a part of the taxable income. So effectively you can get 10.53% of a tax saving on any qualifying R&D expenditure. But for most of us that are advising clients, we're going to be advising small and medium-sized enterprises. Bounceback loans and CBILS, perhaps not as massively relevant now because we're a couple of years on, but it has formed a part of our process when we speak to clients. And the reason for that, if you just cast your mind back a couple of years when the coronavirus pandemic was at its height, the government did provide cheap loans or easy to obtain loans to a lot of businesses to help support them through difficult times. Now, those loans are classed as notified state aid. And the reason that that's an issue for R&D under the SME scheme is that the R&D SME scheme is also a form of notified state aid. And within the rules for claiming R&D tax relief under the SME scheme, it says that it asks whether the project has qualified for any other form of notified state aid, which means that if the company has received a bounceback loan or CBILS, we need to be considering whether or not we can claim R&D tax relief under the SME scheme. We have had a couple of cases with this with clients, and it has involved discussions with the clients to really understand how they utilise the loans within the business. And what we did find in a couple of those occasions is actually the loan wasn't used on a qualifying R&D project. It was used to support other elements of the business through those times. And because it wasn't directly used in the R&D project, it didn't necessarily disqualify them from claiming R&D tax relief under the SME scheme. Now, that is something that we did disclose on the claim, so you know, it's something that we told HMRC about, and if they have an issue with, they can come back to us, but they haven't. So I think really what we need to understand is how that loan is utilised, because really it's whether the project is qualified, has received notified state aid, not necessarily the company. So these are questions that you should be asking your clients if you do find that they've got a bounce-back loan or recipients. But if we do find ourselves in a position where the SME scheme can't be qualified because the relevant project has received notified state aid in some other form, the RDEC schemes can still be claimed. So the small or medium-sized enterprise, even if it's disqualified from claiming under the SME scheme, can still claim under the RDEC scheme. So it still can get something back. But as we've said, the RDEC scheme is not quite as favourable as the SME scheme. Well, so what's it all for, really? You know, we need to ask the conversations we need to be having with our clients really is how they utilise the relief for their company. So we've got qualifying projects, we've got qualifying expenditure, we've reduced the profits or enhanced the loss, and we're in a position where I can potentially claim a repayable tax credit. Oftentimes, and I've noted down the slide, the cash is king. The credit itself is slightly lower than the potential tax relief. And what I'm thinking about here really is that you've got a loss which could be set going forward against future profits of the business. If we're surrendering that, we're getting a repayable tax credit of 14.5%, which isn't quite as favourable, but it's a cash injection into the business. And cash now is probably better than potential savings going forward. So we do find on a lot of occasions that the businesses that we're dealing with are wanting the cash up front because it's just better for them. And it's something that's tangible that can be used to help the business now. And really, if the business is likely to make losses into the foreseeable future, and you do find that with many businesses that are undertaking research and development, there is a lot of upfront cost on the research and development side before that gets brought to the market, and they can really start making some profits out of the products or services that they're providing. We're going to be making losses over a number of years, then really that repayable tax credit is going to be much better because it's going to be a long time before we're going to see any tax relief from the enhanced losses. But of course, the flip side of that is that corporation tax rates are increasing, or have announced. It has been announced that they will increase from April 2023. We'll see if that does come through, but if it does, then what we're looking at is a difference between a 14.5% tax credit or potential savings of up to 25% in the future. So that's something to think about as well. And the last slide I wanted to take you through was getting it right, really. Many of you may be aware that the R&D tax credit, R&D relief, has probably been addressed by the government as being ripe for abuse. And I think there's a lot of, allegedly a lot of bogus advisors out there finding claims for companies that probably shouldn't be claiming it. So as a result, the government has taken quite a few steps to address the abuse of the R&D scheme, and they're making it not necessarily more difficult, but they're taking a closer look at what is and what should be getting R&D tax relief. The claims are now restricted to £20,000 plus 3 times the company's relevant expenditure on workers, which is broadly the pay-as-you-earn and NIC liabilities. And they have also brought in, I think it was 100 compliance officers into the R&D department at HMRC, and they've increased their resources to really assess the claims that are going through. I believe there was a time that only really the larger claims were getting checked, so a lot of smaller claims were just getting nodded and gone through, and people were getting their claims, and not all of those claims may have been right. So now we've got a much larger team that's looking through these R&D claims. And I did see an article in the news the other day that said that HMRC have placed certain R&D claims on pause whilst they investigate irregularities in those claims. So we are seeing them getting scrutinised a little closer. So it's probably more important than ever that we are putting in a robust claim for R&D tax relief, because we don't want that for our clients. We want everything to go through first time, ideally. There's also been some measures that have been announced that are supposedly coming in from April 2023. In that companies will need to inform HMRC in advance if they plan to make a claim. Now, there's no legislation that's been brought through yet, so it remains to be seen how that process will work. But it's something to be aware of. going forward for next year. And the claim itself will need to be endorsed by a senior officer of the company, and also details of the agent who prepared the claim or who's advised of the claim will also need to be provided as a part of the claim. I think there really is what HMRC is doing, is looking to find which advisors are putting through less than robust claims, because I think if their name is attached to one claim, it might flag them up for others to come up as well. And they've also requested that a full narrative is required alongside the claim, which is interesting because that's something that we've always done. We've always provided clear evidence of what the project is about and what it's seeking to achieve and why, therefore, it qualifies for R&D tax relief. Really, with anything that's being submitted to HMRC, we want to make their job as easy as possible to give us a green light. So that's something that we've always done, but is now something that looks to be becoming a requirement going forward. But now more than ever, it's important that advisors are taking care and giving care and attention to the claims that they're putting in for their clients, because they are probably going to be scrutinised a little closer than they were previously. And that does bring us to the end, I think. Every client has different circumstances. There's no one-size-fits-all approach. We really need to be thinking through everybody's situation fully and advising them appropriately. If you do have any questions about R&D or about any other tax queries in general, please do feel free to give myself or Ben a call on the number below to discuss your client situations. I think, yeah, and our next seminar is on plastic packaging tax, which will be hosted, I believe, by Laura and my colleague Paul, which will be on the 15th of July. So if you want to come along to that, please do. You should get an invite. Please get signed up. Laura, did we have any? I think we've got 2 or 3 minutes before the end of the webinar. Did we have any questions?
Yeah, we did. So the first one was, can you claim R&D tax relief as a subcontractor?
That's an interesting one. I think Ben probably touched on it at the start of the webinar, in that it's important to understand who has ownership of the R&D project. So if you're subcontracted to do R&D for another firm, but they ultimately have ownership over it, even though you might be doing R&D type activities, it's not your R&D, so you wouldn't be able to make a claim. But the firm that owns the R&D, if they are subcontracting people in, I think they can claim 65% of those costs from memory. So the subcontractor costs can get relief, but it's ultimately the company that owns the R&D that will get the tax relief. that was it. That was my. Still there, Laura?
I'm muting myself.
Right.
The next question was, can you claim R&D as a sole trader?
With R&D, because it's a company tax relief, it won't be available to sole traders, unfortunately. So yeah, that's just a clear position there, that R&D can only be claimed by companies.
So if you want to claim R&D, get set up as an audit company. Would be the conclusion there.
Yeah, the whole idea is that the government wants everyone to invest in becoming the next Tesla and inventing stuff for the benefit of the whole
humankind.
industry. Yeah, humankind.
Have we got any more on there, Laura?
I think Rosie submitted some questions into the chat box, whether is anyone having issues with the PAYE cap. They're struggling to submit where the employer does not have a PAYE scheme, as the software will not allow them to enter zero into the total national insurance contributions or pay gap.
Right, so that seems like it's more of a kind of a compliance issue. So what we're saying there is that the company doesn't have any pay-as-you-earn employees, and that's restricting the scheme. Sorry, let's see if I can get the Q&A box up. Rosie, just having a look at your query. Periods where the employees don't have a pay-as-you-earn scheme, so it's limited by the 20k cap. It's not something that we've personally experienced. in many cases, we do advise accountancy firms, so we do assist with preparing the scheme, but ultimately it would be down to them to undertake the submission. So it's not something that we've personally had any experience with. Perhaps it's something to raise with our software providers, or speaking to HMRC about to look at alternative ways of getting the claim in. But I haven't experienced that personally, Rosie.
I think, Rosie, just your other question about experience difficult with submissions. It might be worth speaking with HMRC regarding that point, if it's at HMRC's end. It might be worth giving them a call just to see, what's going on, really. But yeah, we haven't, as Ryan said, Rosie, we haven't had any dealings with that, any difficulties.
No, can't cast any light there. I think that brings us to about 10 o'clock. So if anybody else has any questions, do feel free to get in touch with us. We will open up a breakout room for anybody that does want to stick around now and ask us any questions directly. But otherwise, to everybody that has come along today and attended, thank you very much. And we hope you found the webinar useful.